Hello class and welcome to our fourth lecture series on principles of accounting or financial accounting, and I'm your instructor Jamal Haider. So in our previous class we talked about transaction analysis, and then we talked about how we are going to utilize the financial impact regarding the balance sheet equation. So means if anything, any transaction occurred, it at least hit two accounts or two sides, or at least one side whatsoever. The balance should be equal, and assets is equal to liabilities plus owner's equity. And then we go further, and then we develop that, okay, how we are going to analyze the transaction in double entry system. So up till now, we have just studied the accounting equation system. Pretty much that's it. But now on, we are trying to understand the double entry system, which is every transaction must hit at least two accounts. And then we talked about that, what happened if assets account increase, or what happened if liabilities and owners account decrease or increase. So there's a specific terminologies. Remember, I'm going to repeat that one. That debit doesn't mean that is plus, credit doesn't mean that is minus. Okay, we need to understand the logic that if increase, then which side we are talking about, right? So let's talk about that. So what we talked about here, that the assets is equal to liabilities plus owners equity. So we talked about in our previous lecture that if asset increase, we thought that this is debit. If asset decrease, we call this credit. And then we talked about the liabilities. So the right hand side of the equation, if liabilities and owner's equity increase, you see credit, right? Okay, we talked about this later. So if owner's equity and liabilities increase, credit. If liabilities and owner's equity decrease, we see debit here. Then we talk about three account: dividend, dividend, retained earning, and expenses, right? So in order to understand that one, we talked about the formula of retained earning. That retained earning is equal to, that is revenue, not the RE. So we know that the retained earning formula is net income. Sorry, my bad. Let me erase this. It is sale minus expenses, right? Minus dividend, right? Or sales. In some books you call that sale, in other books you call this revenue. It's one and the same thing. Okay, so don't just get confused with the word revenue or sales. So you see here, revenue increases the retained earning. So that's why increase in retained earning by revenue means credit, right? Expenses decrease the retained earning. So that's why decreasing the retained earning, right? It's debit. So that's why if expenses increase, it basically are expenses basically are decreasing. It means they are decreasing retained earnings. So it should be debited. If you don't understand the concept, just remember that there are two exceptions that belongs to the stockholder equity, and these are expenses and dividend. So when dividend and expenses increase, it means they are debit, though they are a part of stockholder equity, which is increase in stockholder equity, credit. But dividend and expenses are two exceptions. I just gave you the logic. Logic is that the dividend and expenses decreases the retained earning decrease debit. So that's why increase in dividend is called debited. increase in expenses also called debited, right? So that was just our recap of our previous lecture. Let's move forward. Right, so if assets increase, debit, asset decrease, credit. So, and then we talked about, yeah, in our previous lecture, we also talked about the T account. So left hand side is called debit, right hand side is called credit, right? So in that case, if something is increasing, so where we should put the values? If it is debited, on the right side of the T account, right? So today we will learn that how we are posting our entries to this kind of T account. Similarly with the stockholder equity, see, if stockholder equity increases, credit. Retained earning increases, credit. Revenue increases, credit. But dividend, see, if dividend increase, it's debited. Expenses increase, it is debited. Right, guys? Okay, now let's talk about the recording part. So whenever question asked or whenever the accountants they talk about recording the transaction, it means journalizing and posting. So this is accounting terminology. So recording means you are basically journalize the transaction and post it into its relevant account. Posting means that you are posting into T account. Generalizing means that how this entry is to be journalized, is to be recorded, or is to be it's okay, which two accounts we need to hit, or at least two account it needs to hit, and we record that one. Let's talk about first journal. So journal, this is not journal with G. Many students when they heard journal, they just when a when in exam they just write it down like journal. This is not like that. This is JOURNAL, journal. So which basically record transaction chronologically, which means in order, in date wise. So it means it can never happen then it can never happen that the transaction of 31st of so 30th of September is going to be recorded at 29th of September, or 29th of September transaction going to be recorded on 30th of September. It's not going to happen. Okay, it's never happening. Okay, and then there are three steps in which you basically generalize the entry. First of all, you classify that the transaction hit which kind of accounts. Either it hits asset account, liability account, or stockholder equity account. And then you need to determine that whether this transaction, the account is going to increase or decrease, whether debited or credited. And then you basically make the entry. So recording the entry is like that. First, you need to write debit side, and then you write credit side with a tab. We'll see that. What does it mean? So remember, the rule of recording the transaction is that when you make a journal entry, it should be first you write debit and then you write credit. Let's talk about that. Here we go. So we have our continued example of Friday's auto service. So number one, business received 50,000 cash and issued stock. So can you tell me which, at least with two accounts? So issue stocks means common stock is going to hit with this transaction, right? Receive cash, it means cash, company receive cash. And now you need to find out the direction, whether these are increased or decreased. So when company receive cash, cash is increased, right? Guys, you need to also, make sure that I understand that you understand, okay? Please participate. This is really important for all of you to understand this one, okay? So you need to also say that, okay, I understand or not, so that I understand that, okay, we are on the same page. So this is very, very important stuff, because future lectures depends on these, rules, and this is basically the building blocks, foundation. Okay, so which two accounts we just find out through the transaction? Okay, cash increase, we just put the the plus minus marks here, that cash is increasing. And if company issues stock, it means stocks are increasing, right? Now, debit credit. So tell me, if cash increase, cash belong to assets, right? If asset increase, it means
Is if increase is debited,
right? Because
no?
cash belong to assets. Cash is the account of asset.
Yeah.
Sorry, yeah, account of asset. And common stock belongs to stockholder equity, SHE. I'm just writing down the abbreviation here. So it is also increase. So when stockholder equity increase, it means
I think it's credited.
credit, right?
Yeah.
So how you write down the entry? First, you write down the debit side. So this is a journal. You mention a date. So you make like a column here. So this is like, see, you make this 1, 2, 3, and this 4 columns. And you write it down, right? Date, accounts, debit, and credit. Okay. So this is the April 1st, April 1st transaction. Okay. You write it down the April 1st. Why? Because journal records the transaction chronologically or in order wise. So that's why you write it down. This is the April 1. So debit side. So you write it down the cash, right? Sorry about my writing here. Cash. And then cash. So you make a space here, right? And then you write it down common stock, right? Common stock. Oh, let me just give you a very nice writing here. Ignore my bad writing here, please. So you write, you start from cash, 50,000, it's debited. So you write on the debit column, right? Cash to common stock. So how we pronounce this entry? Cash to common stock. So it means whenever we, hear, or whenever I say, even though we don't have this journal entry, if I say cash to common stock, so it means what I'm talking about, cash is debited, common stock is credited. So how we pronounce this entry? Cash to, let me write it down here, cash to common stock, which means cash is debited, common stock is credited, right? And how you write it down, this is how I pronounce this, how you receive the audio, or if some, for example,